A lot of Canadian business owners think the heavy tax planning ends once they sell the business, but that's not always the case. Your holding company isn't just a parking lot for cash. It could be one of the most powerful tools for reducing personal taxes in retirement. And if you're not using it intentionally, you could be paying more income tax than you need to, triggering avoidable OAS clawbacks, and missing out on opportunities to pass wealth to your family tax efficiently. The truth is, a holding company isn't just about protecting assets, simplifying ownership, or purifying an operating company. It's also a key part of building a tax-efficient retirement income plan, but only if you use it the right way. Hi, I'm Stefano Francesca, certified financial planner and senior wealth advisor at Next Step Wealth Management with IPC Securities Corporation. Today, I'm going to walk you through 3 practical ways Canadian business owners can use a holding company to reduce personal taxes in retirement. Not in theory, but in real strategic ways that can help your money last longer and leave a greater legacy. Whether you've already sold your operating company or you're planning to retire in the next few years, understanding how to use your holdco properly can make a 6-figure difference over your lifetime. If you find this helpful, don't forget to like, comment, and subscribe. It really helps more Canadians see this. And if you'd like to explore how these strategies can work in your own plan, book a call with me using the link in the description below. Let's dive in. Number 1, income smoothing through dividends. One of the most powerful yet underused advantages of a holding company in retirement is the ability to control the flow of income through dividend payments rather than being locked into rigid income sources like pensions or RRIFs. For example, let's say you've built up a large amount of retained earnings in your operating company. You've transferred those earnings into a holding company. Now you're retired and you need to start drawing income. Instead of taking a large lump sum payout or a taxable salary, you could choose to pay yourself gradually through dividends. Here's why that's powerful. Dividends give you control over your taxable income each year. You decide how much to take and when. This control means you can stay within a lower tax bracket and avoid higher marginal tax rates. Reduce or eliminate old age security recovery tax by keeping your income below the clawback threshold. Preserve access to income tested credits like the age amount. You can coordinate tax efficiently with other income sources like CPP, OAS, RRIF withdrawals, rental income, and so on. Here's an example. Managing around your old age security. If you know you'll start CPP and OAS at age 65, you might keep dividend payments minimal in those years to avoid pushing your taxable income above the OAS threshold. If you retire at 60 and have no other major income, you might take larger dividends early, using up lower tax brackets and triggering no OAS recovery tax at all. Here's the tax angle. Canadian-controlled private corporation dividends can be eligible or non-eligible, each with its own gross-up and dividend tax credit. In Alberta for 2025, a $60,000 annual non-eligible dividend could have an average tax rate of roughly 6% if it's your only income. The same $60,000 from an RSP or RRIF withdrawal could face 13.5% average tax. That's a difference of several thousands of dollars annually on the same income. Another way to look at it is that you can take out more from your holding company in dividends and pay the same amount of tax as if you withdrew from fully taxable sources. Either way, your dividend income is far more tax preferred. There are other advantages over RRSP or RRIF withdrawals. RSPs must be converted to a RRIF by December 31st of the year you turn 71, with mandatory minimum withdrawals that increase annually. A holdco has no such rules. You decide when to start, how much to withdraw, and how to coordinate those withdrawals with your other income and tax planning strategies. One caveat: if your holdco earns more than $50,000 in passive investment income annually, part of your corporation's and affiliated company's small business deduction could be ground down, affecting active business income taxation. The bottom line, this isn't about avoiding tax, it's about intentionally managing income across your retirement years to minimize unnecessary tax and maximize what you keep. Number 2, deferring personal tax through corporate investing. Let's say you've successfully purified your operating company in preparation for a share sale, or you've moved dollars from your opco to your holdco to reduce business risk. Many people might think they should immediately pull that out and invest it personally, but in many cases, you're actually better off leaving those funds inside the corporation and investing corporately, and at least for a while. Why? Because corporate passive investment income, while subject to tax, allows you to defer personal tax until the funds are actually withdrawn. So even though, depending upon your province, there could be a small tax cost for investing in your corporation versus investing personally, there is still a significant tax deferral benefit. So instead of triggering personal tax today, you can invest inside the holdco just as you would personally in a non-registered account. Let those investments grow and withdraw funds only when it makes sense based on your tax bracket and income needs. This is especially useful if you're retiring early and delaying CPP and OAS. You want to gradually draw down your RSP while in a lower tax bracket, or you're holding off on realizing capital gains to manage your income. Even though you'll pay some corporate tax annually on investment income, the flexibility you gain can more than make up for it, especially when combined with capital gain strategies or the use of the capital dividend account, which allows the tax-free withdrawal of funds from your corporation. In short, a holding company lets you decouple your investment growth from your personal income taxes, giving you more control over timing, tax brackets, and estate planning. Number 3, using a holding company to fund corporately owned life insurance. Now let's talk about one of the most advanced but incredibly powerful strategies, corporately owned life insurance. If you're a business owner who doesn't need all of your corporate cash to fund your lifestyle, holding that cash inside traditional investments could expose you to the passive income grind, which we just discussed, that can claw back your small business deduction, ongoing annualized tax on interest, dividends, or realized capital gains, and eventual tax on withdrawal either during your lifetime or upon your death. But there's another option. You can use corporately owned whole life or universal life insurance as a tax-sheltered growth vehicle inside your holding company. Here's how it works. Your corporation pays the premiums, the cash value grows tax sheltered. Upon death, the death benefit flows into the capital dividend account. A portion, often the majority, of the benefit can then be paid out tax-free to your estate or heirs. And finally, while you're alive, you can collateralize the policy and borrow funds to create a tax-free income. This strategy helps offset taxes payable at death, provide liquidity to your estate, and reduce the overall corporate tax burden during your lifetime. It's not for everyone. It needs to be carefully evaluated alongside your income needs, estate goals, and corporate structures. Sometimes these programs are heavily marketed with only the benefits in mind, but structures like this are not without risks, and those need to be explained prior to locking away your hard-earned money. But for business owners with significant retained earnings, corporate-owned life insurance can be one of the most efficient tools available for long-term tax and estate planning. So let's quickly recap. A holding company isn't just a post-retirement placeholder. It's a strategic tool that can help you, 1, smooth your income using dividends and control your personal tax exposure. 2, defer personal tax by investing inside the corporation and timing your withdrawals wisely. 3, reduce estate tax and create tax-free transfers using corporately owned life insurance. Very important to understand that not one of these strategies works well in isolation. To make the most of them, your investment plan, income plan, tax plan, and estate strategy all need to work together. And that's where personalized advice, planning, and implementation makes a real difference. If you're a Canadian business owner nearing retirement or already retired with retained earnings in a holdco, and you want a personalized strategy to reduce taxes and create a more efficient retirement income stream, click the link in the description to book a consultation. We'll help align your corporate structure and investments with your personal goals and make sure you're not leaving thousands of dollars on the table in unnecessary tax. Let's take the next step.